What do you get when you combine a tariff-driven trade war with a global supply chain that was already under pressure? Turns out you get a pretty good earnings report for the company that makes the software, keeping those supply chains from falling apart.
Manhattan Associates, ticker MANH, they reported Q1 2026 last night, and the headline number that's getting everyone's attention is an adjusted EPS of $1.24. That's a 12.7% beat against a $1.11 estimate.
12.7% in a market where people are celebrating penny beats. We're going to dig into what's driving that, why the supply chain chaos you've been reading about is actually a tailwind for this company, and whether the stock, which is not cheap, has more room to run.
And whether a 37x earnings multiple is something you should be comfortable paying for a supply chain software company, even a really good one.
I'm Hudson Thomas, she's Lana Chen. Welcome to Charged Alpha episode 183. Let's set the stage. So, let me give everyone the 30-second version of who Manhattan Associates is, because this company doesn't get nearly enough airtime outside of enterprise software circles. Founded in 1990 in Atlanta and still headquartered there, they build the software that tells your warehouse where everything is.
More precisely, they make warehouse management systems, order management systems, and transportation management software. The trifecta of supply chain execution. When a retailer is fulfilling an e-commerce order, routing it through a distribution center, and sending it to your doorstep, MANH's software is often the operating system behind all three steps.
And what makes them interesting right now is that they pulled off something most legacy enterprise software companies fail at. They completely rewrote their platform for the cloud. In 2019, they launched Manhattan Active, cloud-native, continuous delivery, never a painful version upgrade again. Over 1,000 enterprise customers rely on it.
Revenue comes from three buckets: cloud and subscription, which is the growth engine at $117 million in Q1, up 24% year over year, professional services from implementation work, and a shrinking legacy maintenance stream. The cloud piece is what drives the multiple and the growth story.
Competitors are a mix of private and public. Blue Yonder, owned by Panasonic, is the most direct rival. SAP and Oracle have enterprise footprints with competing WMS products, but none of them made the full cloud-native bet that MANH did, and that's showing up in the RPO numbers.
We'll get to RPO, it's a big part of the story.
The company is being led by Eric Clark, who took the CEO seat in February 2025, coming over from NTT Data North America. He succeeded Eddie Capel, who was the architect of the cloud transformation and ran the company for over a decade.
Clark came up through enterprise software and consulting, spent time at Accenture, ran NTT Data's North American business. He's well regarded in the space, though he's less than 2 quarters into the MANH job. So far, the results have been clean. A beat and raise in Q1 is exactly what you want to see in a new CEO's early innings.
Analysts generally view the transition positively. Capel built something durable, and Clark's job is to accelerate it, particularly on international expansion and deepening the product suite. The smooth handoff was a deliberate signal from the board, and it worked.
The reputation watch for Clark is simple. Does he maintain the operating discipline and cloud growth trajectory that the market is paying a premium for? So far, yes.
All right, let's dig into the financials. I'll hand it to Lana here because there's a lot to unpack.
Let's start with valuation, because this is a company where the price you pay matters a lot. At $134.89 a share and a market cap of $8.1 billion, MANH trades at 37.8 times trailing GAAP earnings. Forward PE on 2026 estimates is closer to 25x given the raised guidance. Price to sales sits at 7.3 times trailing revenue.
That's not cheap by any measure.
It is not. PB is 39 times book value, which looks extreme, but is largely a function of aggressive buybacks that have compressed the equity base. EV to EBITDA on a trailing basis is roughly 28 times. So across every lens, this is a premium software multiple.
Now let's talk about what's generating the revenue. Q1 2026 came in at $282 million, up from $263 million a year ago. That's about 7.4% total revenue growth year over year. But the mix shift is where the story lives.
Cloud and subscription revenue grew 24% to $117 million. Professional services, the implementation work, came in around $126 million, up modestly. Legacy maintenance continues to decline as customers migrate. Total revenue of $282 million beat the $279 million estimate by about 1%.
And the EPS picture is interesting because GAAP and adjusted tell different stories.
GAAP diluted EPS was 69 cents estimate, an 18.8% beat on GAAP. Adjusted EPS, which excludes stock comp and amortization, came in at $1.24 versus $1.11, the 12.7% beat that got everyone's attention. Both beat. That's important.
Now, Lana, let's talk about the margin profile, because this is a software company and margins are everything.
Gross margin is approximately 55%, which is lower than pure SaaS peers because professional services, which is a lower margin business, makes up close to half of revenue. As the cloud mix grows and services shrinks as a percentage, gross margins should expand over time. Operating margin on a GAAP basis is around 23 to 24%. Adjusted operating margin guidance for the full year is 34.9% to 35.1%. So there's a meaningful gap between GAAP and adjusted due to stock compensation.
ROE is 24%, which sounds reasonable until you remember that the equity base has been hammered down by buybacks, so that number is flattered. Net margin on a GAAP basis runs around 17 to 18%.
The balance sheet is clean, $226 million in cash, $56 million in capital lease obligations, effectively no financial debt. Net cash position of $170 million, total assets $741 million, stockholders' equity $205 million. Operating cash flow on a trailing basis is roughly $336 million, free cash flow around $320 million. This is a high-quality, cash-generating business.
And the deferred revenue number caught my eye. $356 million on the balance sheet. That's money customers have already paid for services not yet delivered.
Right. And the bigger number to watch is RPO, remaining performance obligation. That's the contractual backlog, everything they're obligated to deliver under signed contracts. As of Q1 2026, RPO hit $2.35 billion, up 24% year over year. That is exceptional visibility for a company doing $1.1 billion in annual revenue.
So they have more than 2 years of revenue already contracted. That's the kind of number that keeps a multiple elevated even when the near-term growth rate doesn't look dramatic.
Overall, Manhattan Associates' financial health is strong. Clean balance sheet, no financial leverage, outstanding free cash flow conversion, and a contractual backlog that de-risks the next several quarters of revenue. The valuation is the only thing that gives me pause.
Let's talk about what the street thinks. 8 analysts have buy ratings, 3 have holds, 0 sells. The average price target is $228.87, which represents nearly 70% upside from here.
The target range is wide, low of $145 from Rothschild, which is basically flat to current, and a high of $250. Post-earnings, Stifel maintained buy and trimmed the target to $204 from $260. Raymond James stayed outperform at $240, and Baird raised to $230, citing the EPS beat and guidance raise.
Rothschild is the lone neutral, sitting at $145, making the argument that the valuation premium leaves limited margin of safety if execution slips. It's a fair bear case framed as a hold, not a sell.
Last earnings, revenue beat at $282 million versus $279 million estimated. GAAP EPS beat at 82 cents versus 6. Adjusted EPS beat at 124 versus 111. Guidance raised on both revenue and EPS. The street broadly likes this report.
Let me lay out the bull case, because there's a pretty compelling set of reasons to be excited about MANH here. First, cloud revenue growing 24% with a $2.35 billion RPO at the same growth rate gives this company extraordinary revenue visibility. Most software companies would kill for that backlog to revenue ratio. Second, the macro environment. Third, the raised guidance signals management confidence. When a company with a 12.7% EPS beat raises the full year, that's not sandbagging. The midpoint of the revenue guide at $1.152 billion implies continued acceleration. Fourth, operating leverage is structurally improving. As cloud revenue grows and becomes a bigger share of the mix, margins naturally expand. The adjusted operating margin guide of 35% is a strong number for this business model. And fifth, buybacks. The company spent $179 million on buybacks in Q1 alone, with only a $226 million cash balance. That's aggressive, but they're generating enough free cash to sustain it, and it's a clear signal that management believes the stock is undervalued.
Now the bear case. And I want to be clear, I'm presenting this as an analyst, looking at the data, not making a recommendation. The valuation is the starting point for every bear argument. 37.8x trailing GAAP earnings is a price that demands perfection. 1/4 of cloud deceleration from 24% to, say, 16%, and you could see this stock trade down 20 to 30% without any change in the underlying business quality. Professional services is roughly 45% of revenue and is inherently lumpy. Large WMS implementations can slip a quarter, get delayed by customer budget freezes, or see scope reductions. This is not predictable SaaS recurring revenue, it's project-based work. The tariff argument cuts both ways. Supply chain disruption can drive demand, but if tariffs cause enterprises to broadly freeze capital expenditure decisions, that could delay new MANH implementation projects, even as existing customers deepen usage. CEO transition risk is modest but real. Eric Clark is less than 2 quarters in. Even good executives can make early tenure missteps. And MANH is a company where culture and product vision were deeply tied to Eddie Capel's leadership for over a decade. And that $105 spread between the low and high analyst price targets, $145 to $250, tells you that even the professionals don't agree on how to value this business. That range represents genuine uncertainty about the right multiple for a company in transition from services to cloud.
Let's put MANH in context against some peers. The comparison is tricky because Blue Yonder and Infor are private, so we can't do a direct side-by-side. But we can look at other high-quality vertical software companies to calibrate the valuation.
Veeva Systems trades at around 11x sales. That's a vertical SaaS leader in life sciences with a similar sticky customer, high switching cost profile to MANH. ServiceNow trades at about 15.5x sales with faster revenue growth around 21% annually. Cadence Design, mission-critical EDA software, trades at roughly 12x sales.
So MANH at 7.3x sales is actually trading at a discount to these software peers on a price-to-sales basis, which is interesting given the premium GAAP PE multiple.
It reflects the revenue mix. Because professional services, lower margin, non-recurring, makes up nearly half of MANH's revenue, the price-to-sales ratio looks more modest than a pure SaaS company. If you stripped out the services revenue and valued only the cloud and subscription stream, the implied multiple would be much higher.
The options market is painting a pretty calm picture. Put-call ratio is 0.72, which is moderately bullish. IV percentile at 38 means options are not particularly expensive. The market is not pricing in elevated near-term risk post-earnings.
There was notable call activity on June $145 strikes post-earnings, suggesting some traders are positioning for continued upside over the next couple of months. The largest open interest cluster is in May $130 puts, which is some modest hedging activity, but nothing alarming at current price levels.
Insider activity. No open market buys recorded. CEO Clark sold about 282K under a pre-scheduled plan. SVP Bruce Richards sold $1.2 million in March. EVP James Gantz sold $1 million, also March. Total insider selling over the past 12 months is approximately $10 million.
All routine pre-scheduled 10b5-1 plan activity. The dollar amounts look large, but they're consistent with executives managing concentrated equity positions. No panic selling, no departures from disclosed plans. The absence of open market purchases is noted, but not surprising given the elevated valuation.
Let's bring it all together. Manhattan Associates delivered a textbook beat-and-raise quarter. The cloud growth at 24%, the $2.35 billion RPO at the same growth rate, and the 12.7% adjusted EPS beat all tell a consistent story. Enterprise demand for supply chain software is accelerating, and MANH is capturing it.
The key metric to watch is cloud and subscription revenue growth alongside RPO trajectory. If cloud revenue sustains 20% or better growth and RPO keeps expanding, this business is compounding its revenue visibility in a way that justifies the premium multiple. A deceleration below 15% cloud growth would be the warning signal.
The stock is not cheap at 37.8x trailing earnings, But if you're buying a business with a $2.35 billion contractual backlog, 24% cloud growth, a clean balance sheet, and strong free cash generation, you're paying for quality and visibility. Whether that price is right depends on your view of whether the cloud transition runway is still long.
And it is still long. Cloud revenue at $117 million per quarter is growing fast, but it's still not the dominant segment. The shift from legacy maintenance and professional services to cloud recurring revenue has years to run. That's the thesis.
We'll leave you with a quote. This one comes from Eddie Capel, who built MANH into the company it is today. Supply chain excellence is no longer a differentiator. It is a requirement for survival.
That's the world MANH's customers are living in right now, and it explains why, even in a difficult macro, Q1 was a beat and raise quarter.
That's going to do it for episode 183 of Charged Alpha. And hey, if you want to run the same research workflow we used to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street